psychologically, most people cannot stand to see their net worth decline. It deteriorates their standard of living. They just are geared to watch number go up, number go higher, even when you retire. I just met with a really good friend of the family, unexpected um, layoff. Well, he actually was kind of expected. He took a package, and the guy has plenty of money. He's not going to run out, but psychologically, he's having a difficult time trying to figure out, okay, how am I going to get income? That means I'm going to have to tap into my savings. And it's just that for him to make that leap to accept that as a reality is driving a tremendous amount of emotional pain and anxiety for him. And the reality is, most people are that way and they don't change. And you're going to end up dying with too much money in the account. So you have a couple choices.
So, welcome to the Money Alchemist podcast. My name is Brent Gargano.
And I'm Ben Jones.
And we are here today to discuss a pretty relevant topic. The world these days has seemingly gotten pretty expensive. And I don't think, I know I'm getting questions about this topic from my clients. I don't think they're the only ones thinking about it.
Yeah, well, the world has gotten expensive, and also who owns all the capital is a little lopsided. I read a statistic over the weekend that it's like 40% of the people are driving 80% of the purchases in the United States right now. So there's a, and I've noticed this just in my anecdotal experience. There's a lot of pain out there felt by people that that, and it's legitimate pain, the economic pain. They can't really make. They're having a hard time paying grocery bills, gasoline, all that stuff. But then you look around, like on Mother's Day yesterday, you look around, the restaurants are full. Costco's full. It's like the economic activity,
the K-shaped economy,
yeah,
is what this is, right?
Yeah. Well, what it all points to is that there is a segment of the population, according to the statistic, and I wish I could quote it. I don't. And by the way, that means take it with a grain of salt. It may not be true, but I anecdotally think it is. I think it is true that there's about 40% of the population that's driving the majority of the consumption in the United States because, frankly, they have all the money. They have the income. They have the money. That the last episode we did, it was, what percentage of people were in the top cohort? That was like 10% of Americans, I think, had assets of $1.5 million or more.
So we want to talk about, what we're here to talk about today is for that subset of people that has, let's say multiple millions on into the tens of millions of dollars, like how I think a lot of folks in that category are looking at their kids and some of the other people around them.
Yeah, and you bring up an important point there, and that is most of those people are probably a little older.
Sure.
And they're in their later career stages or even retirement stages of life.
Yeah. And no surprise, time helps you build assets, right? So so a lot of the folks that have amassed this wealth are looking down at a world that, and I'm young, so don't let me tell you what the world used to be like, but seemingly it's different than it was when they were growing up. And when I say different, I mean harder to get ahead financially. The cost of housing has gone up. The cost of tuition has gone up. The cost of food. Everything is more expensive, and it doesn't seem like over time. As a matter of fact, I was around the dinner table this weekend and we were talking with a family member. He was telling us the story about how he bought his first house in the late 70s. He paid $75,000 for the house. So I asked him, I said, how much money were you making at the time? And he said that he was making like $50,000. And if you think about it, he was an analyst at the time of some type. The job today would pay pretty reasonably.
It was like 150% of his income.
Yeah.
Mhm.
And today, what do we talk about? I mean, what are a lot of clients buying in terms of relative to their income, price of houses? If you make
It is not even.
$100,000, are you buying
It's
a $150,000
Well,
house?
most people don't even measure it like that. They measure it as a percentage. What is the mortgage payment as a percentage of your income? They don't even think about the total dollar amount being spent.
Well, that same house, we went and looked up that house. That
Mhm.
same house that was bought for in 1970s for $75,000, worth $750,000 today. So it's 10x in value. Where the job that he was working in, if you went and looked at an equivalent job today, it wasn't making 10x the income. It was making 2 or 3x
So that'd
the
be
income.
equivalent of having an income of 562,000.
Right. So the truth is the world today is expensive
Mhm.
relative to where it has been. It costs a lot to own a house and it's tough between student loans. So all of this leads to parents
Mhm.
asking bigger questions about what do we do to support the children. And so when you break down the different ways of gifting, there's really kind of two components to this, right? There's gifting because you want to help, and then there's also gifting for estate planning purposes. So we wanted to take a little bit of time and parse those out here.
Mhm. What we need to talk about is that there are some parents that are most likely, like if you're in that top 10% cohort, for example, especially if you're in that top 1%, there's just no way you're going to spend your capital between now and the day you die. Like a lot of folks say, I want the last check I write to be to the undertaker and I want it to bounce.
Well,
You
that
know?
and that's
And theoretically that sounds great, but it's very difficult to do pragmatically. And additionally, it's unlikely. The most likely thing, because psychologically, most people cannot stand to see their net worth decline. It deteriorates their standard of living. They just are geared to watch number go up, number go higher, even when you retire. I just met with a really good friend of the family, unexpected um, layoff. Well, he actually was kind of expected. He took a package. And the guy has plenty of money. He's not going to run out. But psychologically, he's having a difficult time trying to figure out, okay, how am I going to get income? That means I'm going to have to tap into my savings. And it's just that for him to make that leap to accept that as a reality is driving a tremendous amount of emotional pain and anxiety for him. And the reality is, most people are that way and they don't change. And you're going to end up dying with too much money in the account. So you have a couple choices. You can die with that money, and what a great shape. One of the book of Ecclesiastes is one of my favorite books, and the wise man that wrote the book of Ecclesiastes talks about this. 4,000 years ago, people were facing the same problems, and he actually called it a great evil, a great evil that I die and other people inherit my money, enjoy the fruits of my labor. But that's the reality. We all live it. So when you are in that situation, you have two choices. You can either die and just let, like vultures, everybody comes out and pecks your estate, and who knows what they do with it. Who knows what the vulture does? They may do the right thing, and grow your estate, and it's used to seed the world with positivity, or they may go and blow it all. And I've got some stories that are entertaining there. Or you can strategically plan to give money while you're alive that you probably aren't going to spend, and that through prudent planning you can discover how much you don't need. And then not only that, so this does a couple things. Not only does it benefit the people that you love while you're alive, so you can see how they react to it, but you can also reduce the overall tax burden of your estate. And that you had some really good thoughts on that.
Well, but I think your point is really important, which is that managing a financial plan to zero is not easy. A lot of the planning that we do today is probability based,
Mhm.
meaning that when we run a financial plan, we're kind of managing so that even in bad outcomes, you're still not going to be destitute. And so that the reality of that is that if I'm planning so that in, 85% of all these different good and bad and market scenarios that 85% of them work, there's the 85% that do work. Most of those you end up with a lot of money.
Mhm.
And so I think it's a really challenging balancing act of how do I make sure that I'm taking care of myself and I'm not shortchanging myself while I transition money or help those around me. And we can say kids, but there's so many other ways that you can use your money to impact people's lives that are outside of kids. But getting back to the question that you were asking, so we want to lay out just a little bit of the basics of some of the financial planning for this. So let's get into some rules. So when we think about gifting money, there's a couple of limits to keep in mind. So the first of which is $18,000. And $18,000 as of 2024 is the amount that you as an individual can give to somebody else without essentially having to without having to file a gift tax form. A lot of people when they hear this, they think, oh, if I give more than $18,000, they owe taxes. And that's not really true. What happens is if you give more than that $18,000, the government tracks how much more you've given cumulatively over time. And over the course of your entire life, the way that the rules work now, you're allowed to give away tax-free $13.61 million. And so if you don't have $13 million, you really never have to worry about these taxes. Okay. But if you're in a situation where you you die, I guess backing up, 13.61 is the amount it's called your lifetime exemption amount. So when you pass away, however much money you have up to that number does not get taxed. Anything above that number is taxed, and that tax rate is not nice. So the strategy here for a lot of these, I'll call them ultra wealthy, is to be able to take those assets that would be included in that 13.61 when they pass away and to get them out of their pocket without counting against that 13.61, which is back to that $18,000 limit where that's relevant. And there are strategies to get money out more quickly so that you can reduce the size, reduce the amount of assets that you have counting towards that 13.61 and thus reducing the tax bill that your inheritors owe.
Well, before you get further into it, a couple questions come to my mind. And I know that if they're on my mind, they're on everybody else's mind. One is, how does the government track how much you're giving? How do they know?
Okay.
Yeah. So we'll start with that question.
Well, so there's a tax form that you file. So there are two related tax forms. As we just talked about, there's two limits to be mindful of. The 18,000 is the annual gifting. The 13.61 is the estate tax exemption amount. There are two tax forms that actually track these. One is the 709. 709 tracks gifting annually. So if you gift somebody more than the $18,000, basically when you file your tax return, you have to file this form that tells the government about it. The other form is the 706. The way to remember that is 6 stands for 6 feet under, which is how you remember it's the death tax return. So the 706 is the death tax return, and that actually tracks what are your assets when you pass away, how much of an exemption do you have left. Because again, if you gifted more than that $18,000 limit during your lifetime, whatever excesses you gifted subtract from the 13.61 million. So if let's say you gifted $1 million over the $18,000 limit to your 2 children, you wouldn't have 13.61 when you pass away that you could die with. You would be down to 12.61.
Yes. And so that's per person, correct? So the gift annual gift tax exclusion, the lifetime gift tax exclusion.
Right. So if you're married,
Mm-hmm.
and let's say you're a married couple and you're gifting to a child, you could give 18,000 per spouse.
Wow. So you can get crazy with this. Now, that's just the annual gift tax exclusion. The lifetime gift tax exclusion is just per person, period.
Well, there's something called portability.
Mm-hmm.
So if you have two spouses, each person has their own 13.61 million. When one of the two spouses passes away, there's an election that you make on that 706 form that transfers whatever remaining amount of the 13.61 for the spouse that passed away
To the surviving spouse.
to the surviving spouse.
Mhm.
So if in theory that spouse had no assets, all 13.61 would transition over to the surviving spouse. And so this is why, I mean, again, these kinds of, you don't need to worry about these numbers until you have some pretty significant
Because they change
wealth.
every year.
Well, and they've only ever gone up.
Yeah.
Surprise, surprise. So again, these, back to the core here, there's really two in gifting in general. Yes, there's a financial benefit in some cases. Okay. Think about 529 accounts. I mean, that when you put money in a 529, that's a gift to the
Mhm.
child.
Yeah.
It has benefits where it grows tax-free. So there's clearly financial benefits, but are you putting money in a 529 because you get tax savings, or are you putting money in a 529 because you want to save for your kids' college and not burden them with a bunch of student debt?
I would venture to say it's probably more the latter, but I think that some people do it just for the tax savings. So circling back to the $18,000 annual gift tax exclusion, that's per person, per anyone. So basically, the way you can give anyone up to $18,000 per year, and it's not reported on the form 706. Did I get that right?
Right.
Okay. So I could write a check to you for $18,000. I'm sure you'd be very thankful.
Thanks, Ben.
And it's just free and clear. Nobody needs to know but you and I. And I could do that to you. I could write $18,000 to your kids. I could write $18,000 to my kids, and I can get crazy with this.
Right.
I can give away my whole estate theoretically, as long as every recipient on there is under $18,000.
And
So
you wouldn't have deducted anything from
Mhm.
your lifetime from the 13.61 because all of the gifts would have stayed under that exemption amount.
Yes. So just an interesting exercise. So the richest person on earth currently, is that still Elon Musk? I don't know. Tesla's taken a lot.
Yeah, Tesla
big
stock's
hit
down
lately.
some amount.
Yeah.
So
we'll
who
just say
knows?
it's still him. All right. And he could theoretically give away his 100 billion or whatever he's worth.
$18,000.
Yeah.
at a time.
$18,000.
I don't even know how many $18,000.
Now
chunks
here's
that
an
would be.
interesting thing. If you're married, both of you have your own $18,000. So let's bring this back down to reality, because in reality, you're probably just going to gift to your kids and, maybe relatives if you like them, if your family reunion went the way you wanted it to.
Sure.
So you could do, let's say, my wife and I, we have 4 kids, and we could do $36,000 to each. So just doing the math on there, we could give away per year $144,000, and it's just that in our lifetime gift tax exclusion stays intact.
Right.
That's important because I think one of the strategies that you had involving 529 plans uses that math. But there's one additional caveat. I don't know if you want to talk about that now or we get to it later, but I just wanted to make sure that we were clear on the different limits, because I get that question a lot. A lot of people that I meet with, they don't think they can gift anything without paying. They think that if I give $1,000 to my niece, that's going to be taxed. And you said the exact verbiage you used was not nice. They have to pay a not nice tax rate. Now, for folks out there, that not nice, what that is a top gift and death tax, federal tax is 40%, but it ranges. It starts in at 18%, ranges to 40%.
Yeah. So in theory, if let's say over the course of your life you had gifted some above the gifting limit, and let's say you only have $10 million of your $13 million left and you die with $15 million,
Mm-hmm.
you owe 40% of $5 million. So you owe using rough numbers, you owe about a $2 million tax bill. Now, here's the kicker. A lot of the people that are in an estate tax situation, the $15 million, it's not sitting in cash.
Mm-hmm.
A lot of times it's not even a stock. A lot of times what it is it's a privately held business.
Oh, yeah.
So here's the problem, right?
Mm-hmm.
Who pays the $2 million bill? How do you get the cash to pay the $2 million bucks?
I imagine I imagine you have to be very good friends with the banker.
There's entire industry built around this where venture capital, private equity firms go out and buy distressed assets at discounts because families need liquidity to pay estate tax bills,
Mm-hmm.
right? Because you have a $2 million expense. And let's say, think about a farmer, and they own, a farm can be pretty valuable these days. Think about the subdivision you could put on the farm.
Yes.
Right. So you could have a farm that's worth $20-30 million. And does the farmer have
just in real estate value, mostly real estate value?
And this is where it gets, so getting back to something tangible for the listener, there's really two ways to solve that problem if you have an estate tax bill. Like if you know that you are going to die with more money and the government's going to hit you with this tax, you can start gifting it away as quickly as possible. And we'll kind of talk more about that. But the other thing is, this is where the life insurance salespeople come in, is you can buy, if you're assuming you're insurable, you can buy insurance specifically designed to cover that estate tax bill,
Mm-hmm.
right? And a lot of times, $2 million of insurance might not cost you $2 million out of pocket. And so, again, in the situation of the farmer, maybe, and I don't sell insurance, but maybe there's somebody out there that could.
What a lot of people do, for example, and just to put this in context for a lot of folks, like farmland can easily go for 20,000 an acre. It's out there. So if you have 1,000-acre farm, 20,000 acre, that's a $20 million worth of real estate that you have. That is illiquid.
Yeah.
So if you are the owner, so if I'm Farmer Ben and I own this property in my name and it's not held through an LLC, it's not held through a trust, and I die, my beneficiaries, that is over the 16.1 million. There's essentially going to be a $2 million tax bill owed in federal taxes right there. So where are you going to get it? Well, you either are going to have to take out a loan for $2 million, which good luck with that, especially if you're not going to inherit the operations of the farm. And name me a farmer that can afford a $2 million loan. They're already operating at pretty thin margins, most of them. So you're probably going to sell the land. That's what you're going to do. So you really need to have that insured. Better yet, it's a lot of farmers use specific trusts. Now, I'm not very familiar with these trusts. This is where really a good estate planner would be useful. But there are certain trusts that you can utilize. You can deposit your assets or gift the assets to the trust, preferably early on when the cost basis is lower. And that removes that asset from your estate.
It uses up some of your 13.61.
Mm-hmm.
But the idea is that if you gift the farm away or the business, really this could apply to any business. If you gift the business away when it's worth $3 million and you get it out of your estate and you subtract $3 million from your 13.1, and then when you pass away, let's say the business is worth $20 million, you don't owe further estate tax on that $20 million because it's outside of your estate. But let's bring this back to, I think, some applicable things for, again, there's a lot of people that are having these decisions and not all of them have $30 million farms or businesses. What about somebody that has, let's say, $5 to $10 million?
Mm-hmm.
It's enough money to feel really good about, but it's not so much money that you're worried about estate taxes. You may or may not spend some of it down. So what have you seen in your client base?
Actually, this is something we've seen more and more. I'm a big proponent of not waiting until you die to release your estate to your beneficiaries, because I've seen it go wrong too many times. In fact, I'll actually get real for a second, and we'll talk about one of the the first high net worth clients that I had. He owned a glass company. Great dude. Kids were a little bit of a mess. Their life was a little discombobulated. The marriage of my client wasn't the most stable. I'm not going to get into the details of that, but I'll tell you one thing that he did is he played his cards very close to his chest. It was his money. Probably went into the marital problems, I imagine. Had something to do with it. It was his money, and he was going to die with it. He had this mentality, and I'll never forget. I encouraged him to doing some proactive estate planning, and he it just was never something he could do. Just couldn't mentally make that leap. All right. He had and he did this knowing he had some, I forget what the disease was, but it was what do you call the disease that's mortal?
Terminal.
Terminal. Thank
illness.
you. He had a terminal illness. So I got a call one day that he was dead. He just went to sleep, never woke up. All right. So what do you think happened next? Well, his kids came in
Yeah.
and they said, we're here for our money. And literally these kids went from the poorhouse to the penthouse in a matter of a couple weeks. I will never forget that one son, he came in with this just bucket of bolts, tires were, barely had tread on them. The thing was blowing smoke. And then he drove in brand new Dodge Challenger. This thing was sharp. It had the big, what do you call it? The rumble hood and everything. It was sharp. And I was like, oh man, and I'll never forget that he rolled in, and I know whose money he spent that on. It was dad's money. But here's where it got ugly. All right. Later on, it was about a year or two later, one of his kids who wasn't mentally stable committed suicide. All right. The next son, the one that bought the Dodge Challenger, ran into drug problems because these kids did not need a massive surge of money. That
They
actually
weren't prepared for a massive surge of money.
And now every family's different. There's some kids that could handle that, and it actually might benefit them to do that. Maybe they want to start a business. Maybe there's something they need seed capital for. But I would venture to say most people, when they go from an impoverished situation to an enriched situation. In fact, there's just a statistic about it in the winning lottery. Most lottery winners, they're bankrupt within 7 years.
But here's the question.
Mm-hmm.
What did dad do during the course of raising his kids in terms of having conversations with his kids about money?
Well, he obviously not much.
Right.
Now that's a different issue altogether. And I don't know if we want to broach that topic.
My point that I'm making is kind of like what we've been talking about. There's an element to this that is the mathematics and the logical side of how do I give my money away. Then there's, as there often is in a lot of the things that we talk about, there's all this textbook, fine print that you need to know. But then there's the intangible, like how does this actually work, right? And one of the most impactful things you can do is just talk to your kids. Talk to communicate, set up a process, whether that's working with an advisor, if you need a third party, whether that's, a family, like just set up a family meeting. But over the course of raising your children, I think it's important. Maybe don't divulge everything to them. I'm sure people have opinions on this, but it's important to level set with how you expect that they're, what your expectations are for them related to what they might inherit from you one day.
Yeah. So, and I would say that's at a minimum. Like, again, back to my opinion, that is just one example of several that I've seen. I've seen too many to call out where the beneficiaries inherit, large estates, and then all of a sudden the most evil comes out in them. Alexander Solzhenitsyn said it best, in his book, Gulag Archipelago. He says, the line between good and evil cuts through every person's heart, through every man's heart. So we're all capable of justifying great evils. So I'm not saying that there's good people and there's bad people. I think we're all capable of evil. And when you inject a ton of money into someone's situation, you know, the possibility of evil being conducted is much higher. All of a sudden, like you start.
They just do whatever they,
Yeah,
gives somebody too much
people be
control.
and people get crazy with money. There's folks out there that are just they have a very healthy mindset around money where they would inherit it and they would give a lot of it away, or they would do the responsible thing with it. But I don't know what the percentage is, but I would say that they're in the minority. Most people, when they get money, large unexpected sums, that they engage in unhealthy behaviors. I've seen in the states being settled. I've seen or not heard. I didn't see this of a brother pulling a gun on another brother just because of some perception of wrongdoing. Where's my money? Where's my money, Bill? It's like, oh my gosh, are you not family? Like, what is going on here? So I am a big fan when someone has money that they're not going to spend, give it while you're alive. Give it while you're alive because it does two things. One is it's probably going to minimize your family's tax footprint. The second thing it does is you're going to see how your family operates when they get a little bit of money. And whatever they do with a little bit of money, as they say, they start acting a little crazy and they start asking like, hey, mom, dad, can I have an advance on that? And they start asking for advances, then there's that should be your indication that there's something unhealthy there. All right. And
Well, and
then,
I think but everything you're saying goes
yeah,
back to what I'm saying about communicate and have a healthy family dynamic about the money.
yes.
And part of that's, hey, I'm gonna, and really that to me doesn't start with, hey, I'm gonna give you money when you're 20 years old and see what you do with it. It goes back to, when I take my daughter to the store, I if she wants something, I maybe make her make an allocation decision. Hey, here's how much money we have to spend. Here's how much what you want costs. How are you going to decide to spend your money? I mean, there's so much that goes back to preparing your kids to
Mhm.
inherit the wealth. And I think the situations that you're pointing out are all too common because so many of us don't like talking about money, especially not to our kids. And, you know, really that doesn't do much of anything to prepare kids for what they might have to deal with. And that's a shame.
Yeah. And in addition to that, what is absolute fact right now, you cannot deny it. That is the older generations today. The gap in wealth between older generations today and younger generations is far greater than it was for the baby boomer generation. Baby boomers today are far wealthier than the greatest generation was at their same age gap. And that and I'm not saying I'm not going to like
Well, it's the
public on the
same.
ethics
I mean,
or comment on that.
remember our house analogy where I said the
Yes.
$75,000 house became $750,000 just for just my wife. We were driving home and I
Mhm.
told her that we kind of similar conversation. She said, "Wow, what a great investment." And I said, "Well, how much do you think it would have been if you had been invested in the stock market?" $10,000 invested in the S&P 500, 1980. What do you think it would roughly be worth today?
Oh boy. I'd say I'm going to be totally wrong here. I'm going to say 1.5 million.
Yeah, so $10,000 invested in the S&P 500, January 1980 through January of 2024 would be worth 1.3, roughly, I'm rounding here, $1.3 million,
I was actually close. I was a lot closer than I thought
1,297,000.
I'd be.
So the point is 75
Mhm.
going back, the core point here is that over the last 50 years, the price of assets, be that stocks, real estate, as opposed to the price or the income that people earn, the the divergence is huge, right?
Mhm.
$10,000 invested in 1980 would be worth over $1 million today. A $75,000 house worth 10x what it was, 40 some years ago versus incomes have like maybe tripled or quadrupled.
Yeah, financial asset inflation has been out of control. Um, one of the chief economic analysts for J.P. Morgan, David Kelly is his name. I was on a conference call, and he stated this. Well, actually, it wasn't a conference call. It was at the FPA meeting a year back. Last July, and he stated that deficit spending directs inflation into financial assets, or he says deficit spending diverts inflation into financial assets. So, I think this whole dynamic. Now we're getting off topic, but I think it's going to accelerate. But the truth is, let's bring it back into this conversation. The truth is, a lot of older folks look at their kids living paycheck to paycheck or struggling, and they think to themselves, well, I made it. They can make it. And I think that's the wrong way to look at it. I really do. I think that younger families have a much more challenging time getting their household finances under control, than that same person did, or that same family would have had 20, 30 years ago. And I think it has to do with that, financial assets have inflated, incomes only a little bit. So that gives the older generations, who typically have most of the assets, a good opportunity to support their children in their formative years, and to support their grandchildren in their formative years. I think that the attitude of, well, I made it on my own, so they can make it on my own, and that'll just temper them more, and there'll be better people because of it. Maybe that worked for you. Maybe it did. I think it would probably, what it's going to do is going to cause a lot of resentment. Because I think it's, first of all, what was generationally true for you 3-4 decades ago is probably not true today, and that's because the dynamics of inflation have changed quite a bit. So that's just my thought on it. I'm a big fan of, if you have a lot of capital, you have a lot of money, you're not going to spend it throughout your lifetime. Let's see what we can do to give that while you're still give away some of that while you're still alive, and you may find a lot of reward in that too.
So I mean, what strategies have you seen? I have a couple of things listed here that are, tips and tricks
Mhm.
to gift your money more effectively. But what kind of strategies have you seen your clients do?
Well, one of the more interesting strategies, and you brought this up before we started recording here, was giving into 529 plans for your kids and grandkids, specifically your grandkids, because you can get pretty wild with how much of your estate you can give away. So you can gift, again, up to $18,000 per person. So you can gift that to a 529 plan, and a 529 plan think of it as it's kind of like a 401k for education. They're sponsored by most states. We did an episode about this a couple episodes ago, so I encourage you to go look it up. But 529 plan is essentially a savings. It's a tax preferred savings account for education, and you can give up to $18,000 per year per beneficiary. Now, that's not a 529 plan limit. That's just the limit of the annual gift tax exclusion. But here's the catch. You can actually bring forward 5 years worth of gifts into a 529 plan for one beneficiary. So
Is 90,000 a year.
yeah. So if
So
you're
imagine
married,
if you have, and if you're married, you can double it.
yeah, so that's $180,000 per beneficiary. So let's say you have 10 kids, or 10 grandkids. If you have 10
kids would
kids,
be a
you're
lot.
losing
Yeah.
losing
10
your hair
grandkids
early.
is maybe a little bit more for you,
Yeah.
Uh, five, but the point is, if you have grandchildren, you could do this for each grandchild. And
Yes.
then, by the way, one of the cool attributes of 529s that people don't realize is that you can change the beneficiary in the future. So
Mhm.
let's say that those grandkids either don't go to college or don't use all of the money or whatever, the beneficiary can be changed from there to benefit somebody even further down the family tree than that.
And I struggle to think of a better gift than the gift of education to your grandkids. I think that is one of the best things you can do. And it's almost like the IRS just turned a blind eye to this issue. I think of the IRS as being malevolent. So I think they did carve this out purposefully to encourage investment in education, which is a good thing. But you can give, if you're married, you can give up to $180,000 per grandchild to a 529. Now, you can't give anything to them again without it affecting your estate taxes for the next 5 years.
Right.
But
You're just pulling forward
yeah,
the gifting you would have done over 5 years. The real benefit is the
yeah.
fact that that money now grows from day one.
So let's just say you have 5 grandkids. Let's not go too crazy. So that's I should be able to do that. It's $900,000 you can remove from your estate just like that.
Without incurring any kind of
Mhm.
impact to your lifetime exemption amount.
I know.
Thus
I know.
increasing
It's
your
I mean,
estate
it's
tax.
essentially like it's I pause to say this, but or hesitate to say this, but it's kind of a no-brainer. If you have
If you're dealing with estate tax issues, if you potentially might die over that estate tax exemption amount,
Mhm.
I mean, this is an easy way to
So
just kick money straight
but
out.
but let's not forget that that doesn't solve one of the key benefits or address one of the key benefits that I see to what I call inter vivos gifting, and that is to see how your beneficiaries react with the money when they get it, because ultimately it goes into a 529 plan. It's going to stay in the 529 plan, and you don't really see how they spend it. So what I've done with more than 2 cases, several times, is I've encouraged my client to give money to their kids and grandkids up to that exemption amount per year. Because again, you can give 18,000 per person per year, and that's a lot of money this day and age. That can buy you a lot of, that's a lot of
If you think about
Chipotle.
it this way, for somebody in their 20s, it's $1,500 a month, tax free.
Yes. So, and if you give that to your kids, and this is what I like to see, you give that to your kids and grandkids, and you see, and you don't put any string, you don't attach any strings to it. You just see what they do, and then every holiday you ask them, you say, well, what'd you end up doing with that money? And you find out which ones do the right things, which ones don't do the right things, and then because let's face
But
it,
does that change the way that you would do it? I mean,
yes, it does.
but would it be, I mean, I don't know. I could imagine somebody saying, but I understand my one child is more responsible than the other child, but I still want to make
But
sure
do you know that? So people have surprised me in the past. There have been beneficiaries that came to claim the estate, and I thought to myself after one meeting or 2 meetings with them, like, oh, this money's gone. Like, there's no way they're going to spend it, and then it ends up that they save and save and save. And so people will surprise you. You really don't know. So I think this is true. I don't think you know who someone truly is until they have money. When they have money, that's when you find out who they are. So anyway, back to my what I suggest. And again, this is just my opinion. There's no right or wrong here. This is just my opinion. I like the idea. Again, the 529 plan is a great way to go. But if you want to find out like what your beneficiaries are going to do with your estate, then you just seed them capital every year. You gift them money every year. And if you're thinking about doing this, chances are you've got a pretty large estate. This is not the right, like if you have $2 million in your nest egg and you need $150,000 of income from this
Yeah,
thing,
you're
not
this.
doing this.
Sure.
We're talking like you've probably got
You got five,
7 million bucks and you only need 50 grand a year, if anything, in income. You're not going to go through your
maybe
estate.
not quite that.
Well,
but sure.
you get what I'm saying. Like, you just meet with a financial planner and then have them tell you if you're going to run out of money. If you're not going to run out of money and your Monte Carlos are running at 99, 100%, and you're projected to have a
in reality, I cannot tell you how many plans that I've run for
Mhm.
50 and 60-year-olds that at their current spending levels in like an average market, they die with tens of millions of dollars. And you ask them, how do you feel about that?
yeah.
And I have never gotten an answer of like, oh, I'm really excited to die with all that money. I mean, I'm not saying that it's not. What people do get excited about is like, what kind of impact could that money make? It's not about the money itself. So for me, that's a good place to start with it in a financial plan, because you can then, okay, if you don't want to die with $40 million,
Mhm.
what do you want to do? Do you want to retire sooner? Do you want to spend more? Do you want to gift more to your family?
I
Right?
I think for people, what they want, most of them, is they just want number go higher. Really. That they don't want to spend more. They don't want to necessarily retire early because a lot of folks they get it. They derive a lot of meaning from work. I know I will. I can't see myself truly retiring in the traditional sense. Um, I think I'll probably die doing podcasting. I really love this. This is the kind of thing I love. And I would never just want to retire and like go and tour beaches. That sounds horrible to me. So I think people just like seeing number go higher. And a lot of it actually it's not because of greed or selfishness, it's just a sense of security. It get it
Yeah, the fear of running out
Yeah, the
drives
fear of
more
running out is so
anything.
great. So I think what I like in terms of the small giving little teeny small amounts, up to the $18,000, if you've got a large estate you're not going to spend through, you can afford it.
And if you
And
need to adjust, you can make
yeah,
adjustments.
you can adjust it. You can afford it, but also it tells you a very, very important information. It tells you who your beneficiaries are with money. And then you can, with that lump sum estate that they're going to get, you may not wrap your mind around it. You may think, well, okay, I'm dying with $40 million. Sure, Brent. That's what the paper says, but that's not true.
Yeah, we're
Because
only
that's what
using
they're
like 6 or
thinking.
7% long-term rates of return when
You
we
know,
run
you know
that.
that's
Yeah.
what they're thinking. They're like, oh, that's not going to happen. But I'm telling you, it happens because we settle estates every freaking year, and people die with way too much money, and their kids go nuts. Like it's going to happen, whether you believe it or not. So by giving this little teeny bits of money to their kids every year, or whoever, it doesn't have to be kids, that you find out who they are with money, and then you can modify your estate plan to figure out, okay, who needs capital controls and who doesn't. All right. Does Susie spend money like a drunken sailor? Okay. Yes. Then she's getting income from the trust. Okay. Does Johnny do a good job? All right. Johnny can get a lump sum.
And I think you make a really good point because
Mhm.
most people don't really understand estate planning, right? They think that if they die and they have a will, that that's an estate plan. But the truth is, before your will even comes into play, your assets either have a title, they're either jointly owned or you have a beneficiary on them or something like that. Um, those kinds of things get parsed out. So you can set a trust, like during your lifetime, you can set something called a revocable trust,
Mhm.
which is called revocable because you can change it.
Mhm.
But that trust, when you pass away, if that trust is the beneficiary of, let's say, your, investment account, once you die, that trust becomes irrevocable. And therefore, the rules that are laid out in the, this person can touch money for these reasons and not for those reasons or whatever, you can kind of dictate beyond the grave how this money is going to be used. And so I think, um, for me, I don't want to, this is just me personally. Like, let's say one of my children ends up being terrible with money and one's great. I don't want to disinherit the other one because, that isn't good with money. What I do want to do is put a plan in place and have provisions such that I set them up for success. So, like in a business owner situation, what I've seen here is let's say you have two kids and one kid is involved in the business and the other isn't, right? Are you going to give both of the kids 50% of the business and have both kids be joint owners when one child doesn't know what they're doing? Or do you set it up so that maybe the business is owned by one child and maybe the land is owned by the other and there's a rent payment from the person that owns the business to the person that owns the land. And so the child that's not as financially savvy or doesn't know the business has a stream of income tied to the business. And I let me expand a little bit. I think we should probably wrap this up. I mean, I know we've been talking for a little while here, and we appreciate everybody listening, but we do want to give maybe some additional actionable
Mhm.
advice. I think one of the things that I see in a lot of my clients that are younger and that have high incomes is we don't know the future. When
Mhm.
you look at these estate tax rules, when you look at um, where somebody could be tracking as a 35-year-old, if you're running a financial plan to them being 80 or 85 years old, there's a lot of uncertainty. So anytime that you are thinking about giving money in some material amount above this $18,000 threshold, it's really important not only to communicate with the family, but don't spare the expense of bringing in the right other professionals. You really do want an attorney,
Mhm.
a CPA, a financial advisor. It it's fine if you want to, do family lending. And I mean, a lot of right now, I'm seeing a lot of I'm having a lot of conversations around things like family lending. Those kinds of things, if they're not done right and you do happen to get audited, they can burn you. And
Mhm.
if you do, let's say, you're younger and you mess one of these things up, the state tax is 40%. If it costs you eventually 40% of that money in your estate, there could be some pretty big costs here.
Yeah, the key takeaway, what you're trying to say is competency is not free.
And these things, although it sounds simple for a family member to lend money to another family, all you have to do is give me a check
Mhm.
and I'll pay you the money back. Um, you might see that as a loan. Hey, if I let's say I'm in my you know 30s and I want to borrow some money from my parents to build a house or do something. Um, you really need to make sure that that's clear, that that's a loan
Mhm.
and not a gift. Because as we've been discussing, when you give money in excess of these limits, that gets deducted from your lifetime exemption and thus creates potential
Yeah,
estate
and
tax.
loans are typically pretty large transactions. You're not usually loaning your
Get five
child,
grand.
5 or 6 grand, although that can happen, but
Yeah,
it's usually
family
over
lending is
18,000.
typically decent money.
Yeah. So, that's a very important point. It, in other words, if you have a sizable estate, and this could be for young folks. I know we focused mostly on like the baby boomer type style generation, but there's a lot of clients out there that have means that are younger, that are in their 30s and 40s. And it's never too early to develop an estate plan. You should always have an estate. Actually, in fact, you always do have an estate plan, no matter
Whether
how,
it's dictated
yeah,
for
whether
you
it's
or not.
dictator for you or not. And as we said earlier, especially if you're a young person with a business, you should really be thinking about what to do with that business while the cost basis of the business is as low as it's going to get. Who is that guy, the co-founder of, we talked about this briefly, the co-founder of, not PayPal,
Palantir.
eBay. Who was that? Or no, it was PayPal. It was, who's the co-founder of PayPal with Elon? My gosh, I got to look this up now.
It's
I can't think
Peter
of his name.
Thiel.
Yeah, Peter Thiel. Thank you. So Peter Thiel, early on in the formative years of PayPal, bought shares of the company inside of a Roth IRA when the Roth IRA limits were $2,000. That was worth like billions of dollars. He's got the largest Roth IRA in the United States per the most recent IRS audit. But anyway, or IRS records. I forget who did it. There was some research firm that discovered it. I forget Anyway, but going way off topic. The earlier that you strategize around your business and gifting and all that, the better. So I'd rather a client come to me and then say, Ben, this is what I want to do, and then I analyze their situation and say, oh, it's too soon, than for me to say, oh, it's too late.
Well,
So it's better be too
there's
early.
when you're planning for estate taxes, like, hey,
Hmm.
I may pass away and owe an estate tax bill.
Hmm.
There's two ways to do it. There's proactive, where, like we've been talking about, gifting money out
Yep.
of your estate and reducing your total estate value,
Hmm.
thus, reducing the tax due when you die. And then there's reactive,
Yeah.
which is like we talked about the life insurance. Hey, we now know we're going to owe estate taxes. What do we do to minimize the impact?
Yeah, so the earlier you start planning, it's like an airplane with a runway that's just longer. You don't want a runway. You don't want to land your financial plane on a runway the size of a postage stamp. The longer the runway, the better, and the more competent professionals you get involved, the better as well. Yeah, it's not going to be the cheapest way to do it, but it'll be done competently. And a lot of times I find, especially like I pay for my taxes to be done professionally every year, and the service pays for itself. It's like hiring a professional trainer in the gym. Yeah, you can go to the gym and show up and lift weights, but you might end up injuring yourself.
Well, what you're talking about
Hmm.
is value, and I think it's
Hmm.
important when you're selecting a financial advisor, CPA, lawyer. I mean, these people should be working together.
Oh yeah,
If you
that's.
go to your financial advisor
Mhm.
and you ask questions about this, and they say, "Hey, just go talk to a CPA or talk to the attorney," and you are at the center of that whole conversation, something needs update. I mean, when we work with clients, I know that we meet with the CPAs and meet with the attorneys, whether that's with the client or on behalf of the client, and make sure that we're all on the same page and
Oh yeah,
coordinating
we a
towards
lot
the
of times
same
we talk
objective.
we talk to CPAs and attorneys without the clients even being there. We're just, you were the subject of our attention there. I sometimes having the client there can actually get in the way because you're talking technicals and
Yeah, you can get more accomplished very quickly
yeah,
when you have two people that know
but
what's going on.
the bottom line is, just don't be cheap with it. Cheap investing gets you cheap results. And I think that's true not only with this, but also in like areas of your health. Yeah, you could be your own doctor. You can represent yourself in court. Good luck with that. There's just certain things that you just don't scrimp on. So back to really tie all this together. It's never too early to start an estate plan. In fact, the earlier the better. I if you have means, if let's put it this way, if you have something worth, if you have a net worth of 2 million or more, that puts you into that 10% cohort and higher. You should probably be discussing a retirement income plan with a financial advisor. Find out what your end estate value is going to be. I would venture to say the vast majority of people that meet and do a retirement income analysis or retirement plan will find out that they probably have more than they need. And you need to figure out, I like your question. How do you feel about dying with too much money in the bank? These are very important things to ask yourself. And if you have kids, especially kids that just are having a tough go at it, which there's a lot of people out there that are, you really should consider doing some gifting, some family gifting. Um, and I know that will make a lot of folks uneasy because when money leaves your estate, number go down. Again, as I said, most people just want to see number go higher. That drives a lot of anxiety. But if you meet with a financial planner that's been down this road 100 times, and oftentimes is 100 times a year, and they look at you square in the eye and say, "You're going to be fine. This is just fine." In fact, these are the reasons why I'm recommending this because you're going to either give too much money to the IRS or your kids are going to go crazy, and they can help bring everything into picture and give you that clarity you need to overcome that anxiety. And sometimes that anxiety can transform into just a feeling of, um, I don't know, just a good overall feeling. You just feel like a better person. You feel like you're more um, important to your family versus I just exist and here's my capital and I'm going to die one day and then my kids can just feed on my financial corpse. So anyway, go see go see a financial advisor like Brent. Brent's a phenomenal a resource for this. And with that, where can people find you, Brent?
Best way to find me is my website. It's www.infinitewealthplanning.com or www.infinitewealthplanning.net. It has all of my information on there. There's ways to contact us. Please feel free to reach out.
Yes, and I'm Ben Jones, and I'm one of the co-founders of National Wealth Management Group and SEC Registered Investment Advisor. Best way to follow me is actually on X, formerly known as Twitter. My handle is at the Carrot Stick, and carrot is spelled KARAT, so it's at the Carrot Stick. Thanks for listening. Securities offered through LPL Financial, member FINRA, SIPC. Advisory services offered through National Wealth Management Group, LLC, a registered investment advisor and separate entity from LPL Financial, LLC. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. This information is not intended as authoritative guidance or tax or legal advice. You should consult with your attorney or tax advisor for guidance on your specific situation. Brent Gargano is not affiliated with LPO Financial.